Are you confused looking at those graphs? Don't worry, in this video you will not find any graphs, but rather a simple explanation to microeconomics and macroeconomics. Let's begin. Economics mainly deals with two branches, micro and macro. In this video, you'll be able to identify the different examples under microeconomics and macroeconomics. Let's look at a couple of scenarios as examples under these two branches. So now that we all saw the three scenarios, let's analyze each scenario and figure out what exactly do they fall under, microeconomics or macroeconomics. Scenario 1. There was a single household which was affected by the price of onions. In the picture on your left, you can see that the mother thought of buying more of tomatoes instead of onions because she saw that the price of onions had increased. Therefore, a rise in the price of onions resulted in a higher quantity demanded for tomatoes. This falls under microeconomics. Let's get into the details of microeconomics. It basically focuses on human choices of a single household or a single firm. As you saw in the picture, that a mother was deciding whether to purchase onions and tomatoes, and the price of onions affected her buying decision. Similarly, allocation of resources is based on the prices of goods and services that is offered in the market. Microeconomics therefore focuses on individual demand, individual supply, and equilibrium. It also focuses on production theory and labor economics. Let me give you further examples. Do you have a household budget? Or does your personal financial situation affect your preferences in buying any kinds of goods and services? Well, for example, let's say you or your mother or anyone in your family is going to the supermarket to buy coffee. It is noticed that the price of coffee has tremendously decreased from the last purchase. Therefore, what do you think the demand effect will be on coffee? Do you think that the quantity demanded will increase or decrease for coffee? Let's see. The quantity demanded definitely will increase as the price is lowered, which means that the consumer can now buy two coffees for the price of one earlier. As you can see that this is an inverse relationship in demand, wherein the price is reducing and the quantity demanded is increasing. Vice versa will happen if the price is increasing and the quantity demanded will reduce. Let's take another example. The producer uses aluminium as a raw material in manufacturing process of a car. He notices that the price of aluminium has increased. Do you think that the supply of this product will increase or decrease? You're right. The quantity supplied will definitely increase because the producer's goal is profit maximization. This shows a direct relationship between price and supply. The higher the price, the more the quantity will be supplied. The lower the price, the lesser quantity will be supplied. Now let's analyze scenario 2 and scenario 3. In scenario 2, the chart is on decreasing employment rates which can occur due to lack of skilled labor, high population, recession, losses of your corporates, global competition, limited firm capital. In scenario 3, there is a discussion on the foreign trading policies and its impact on the economy's gross domestic product. As you can see that there is a certain similarity between these two scenarios. Both of these scenarios talk about the impact of these variables on the economy as a whole. This is macroeconomics. In macroeconomics, we talk about how the interest rates, the stock market, the aggregate demand or the aggregate supply, the GDP and GNP, banking regulations, fiscal and monetary policy, the business cycles, trade, employment, and government securities impact the economy as a whole. Let me give you an example. As you can see in front of your screens, there is a depiction of the various business cycles that an economy undergoes. Under every stage, the government changes its fiscal or monetary policy, even the banking regulations are altered. For example, when the economy is under recession, the government can opt for an expansionary fiscal policy. This would mean that there would be an increase in government spending or a decrease in taxes. The opposite would happen when there is inflation in the economy. This is how the business cycles affect the economy as a whole. Coming to the cash reserve ratio. Commercial banks are required under law to keep with the central bank a minimum percentage or proportion of the deposits as cash reserve. This is called the cash reserve ratio. When credit is to be contracted, the central bank can increase this ratio and thereby cash resources of the banks can be reduced and banks are forced to contract credit. Contrary to it, when it intends to expand credit, it can reduce this ratio. This was how the cash reserve ratio can affect the supply of money in an economy. Let's identify the key differences between microeconomics and macroeconomics. Microeconomics deals with individuals and activities within the system. Macroeconomics deals with social and economic status of the system as a whole. Microeconomics helps in determining the individual need of demand and supply chain, whereas macroeconomics focuses on aggregate demand and supply of a target economy. Microeconomics deals with the effect of price levels of goods, services, and raw materials on consumer and producer behavior. Macroeconomics focuses on a general increase in price levels, also known as inflation, and its impact on the economy as a whole. The goal of microeconomics is maximization of an individual's gain, whereas the goal of macroeconomics is maximization of social welfare. Microeconomics has a narrow scope, whereas macroeconomics has a much broader scope. The variables that fall under microeconomics are the amount of a firm's output, consumers' disposable income, quantities demanded, prices of goods and services, and its impact on producer and consumer behavior, among many more. The aggregate variables under macroeconomics are the aggregate demand, aggregate supply, general price levels, rate of unemployment, public budget, stock markets, government securities, and the real output, which is your GDP. Now, to sum up this video, economics has two main branches, namely microeconomics and macroeconomics. Under microeconomics, the choice of an individual is focused upon, wherein the opportunity cost is realized and the needs of an individual are satisfied. Under macroeconomics, we deal with the economy as a whole. Therefore, market demand and market supply come into play. There are innumerable variables that can impact the economy locally as well as globally, therefore, socially and economically creating an impact.